Hi there. For those of you who don't know me, it's Sarah Harkness from In Accountancy, and as I'm sure you are aware, the Autumn-Winter 2018 budget was delivered yesterday. So this morning we've been having a review of the papers and really getting to grips with what this budget's all about and what that means for you and in particular, of course, for our clients. So having a quick look at how the media in general has interpreted this autumn 2018 budget, what struck me and actually surprised me is really it's the first time. All of the headlines are pretty positive. So it's the first time that I can remember where there's only one negative headline from the Daily Mirror about the budget, who asked the question, is that it? Other papers are focusing on the treats rather than tricks and talking about the tax cuts and cash injections for social care, for schools, for defence, and really treating it as a bit of a Brexit bonus. So that's what the papers have been saying this morning, and there have been a lot of comments catching on to things that Philip Hammond has said, like this being a budget for strivers, grafters and carers, like this being the beginning of the end of austerity. But others are asking, actually, is this really the calm before the storm? Because he made no bones about the fact that if Brexit were to happen as a no deal, so if the UK leaves the EU in 6 months' time, that the spring statement, which is planned for March 2019, will actually be upgraded to a full-blown budget. So it remains to be seen what will happen then. But for now, let's concentrate on the detail of this budget and what that means for you as an individual or a business in the UK. So looking at the economy to start with, the good news is that the economy's been reasonably good for the last 3 months. Unemployment continues to fall, inflation is down to 2.4%, and UK wages are increasing at the fastest rate in almost a decade. So that's great, because that means that people are starting to feel slightly better off in real terms, at least. And of course, this will be the last budget before the UK is due to leave the European Union on March 29th of next year. Looking forwards, inflation is forecast to average about 2% next year, which again means that people should see some real growth in their wages. There's a prediction of more than 800,000 new jobs being created over the next 5 years, and the growth forecast is up versus where it was at 6 months ago in the last spring budget. And the Chancellor is also optimistic that both debt and borrowing are forecast to fall steadily over the coming years. So what about investment? Well, a lot of the speech talked about what money was going to be available for public services, with particular focus on the NHS, which will have £84 billion dedicated to it over the next 5 years, and also then the social care. So social care budgets saw 650 million in grant funding, with another 45 million for care of disabled people and another 84 million for children in social care. So all very worthwhile spends. In what was seen as a big win for the Defence Secretary, an extra 1 billion has been allocated to the armed forces to help with immediate pressure, and most of that going on cybersecurity and also anti-submarine capabilities, interestingly. There was no new money for the police, but there was an extra 160 million which has been allocated to counter-terrorism policing over the next 2 years. For schools, there's an extra 400 million has been allocated for what the Chancellor said to allow schools to buy the little extras that normal budgets don't usually afford them. Now this equates to an extra £10,000 per primary school and an extra £50,000 per secondary school. Finally, as a lot of people had expected, came potholes, with an extra 420 million to be given to councils to fix the shocking state of the roads out there. Now, I for one have a lot of cycling friends who will be very, very pleased for that, but others are querying the fact that there's more being spent on potholes than schools. In terms of personal taxation and allowances, the personal allowance is going to rise from April 2019 to 12,500 per person, and that's up from 11,850 currently. And the higher rate tax band will now start at £50,000 per year, which is up from the current 46,350. So it's estimated that 32 million people will benefit from this. And this was going to come into play in 2020 anyway, but it's been brought forward by a year. Now, it had also been expected that there would be changes to the way dividends are taxed, but that has not happened in this budget, which for a lot of our clients is great news. And in fact, we had someone in this morning, and we have recalculated and reviewed their remuneration planning, which has ended up being an additional £4,000 net in their pocket from 2020. Sticking with small business and turning to entrepreneurs relief, there had been an awful lot of talk that entrepreneurs relief might be scrapped altogether in this budget. This hasn't happened. What the Chancellor has decided to do in effect is to tighten the rules around entrepreneurs relief and extend the qualification period from 12 months to 2 years before you are entitled to that relief. Turning to pensions and savings, again, despite an awful lot of scaremongering about what might be in line in terms of pensions and reductions on pension allowances, there's been very little there. The lifetime allowance for pensions will increase in line with the Consumer Pricing Index from 1,030,000 to 1,055,000, and that is from April 2019 also. With regards to pensions for the self-employed, following on from the introduction of auto-enrolment a couple of years ago, there is a new paper to be published in winter 2018, which is really a case of a review following a review, which we assume will eventually lead to new policy. And that is all with the intent of encouraging the self-employed to take more ownership of their retirement and saving for their retirement. The only other thing on pensions was that there's going to be additional funding to the pensions dashboard over the course of the next year. And the pensions dashboard, if you haven't heard of it, is just the government wanting everybody to have visibility in one place of what they have in their pension for their retirement. Whether or not this will actually be available in the next couple of years is still up for debate. Turning to savings and investments, the adults or standard ISA allowance has been frozen at 20,000 for the year, but there has been an increase to the junior ISA allowance, again in line with Consumer Pricing Index, to £4,368 per year. And remember, if you have a junior ISA set up for your child, anybody can contribute into that. It doesn't just have to be yourself, but that's the allowance. NS&I index linked savings, that's not easy for me to say, I must be honest, have been increasingly popular in recent years with interest rates being so low across the board, and those interest rates are now going to be linked to the CPI rather than RPI. It's the Consumer Price Index rather than the Retail Price Index, and that is currently set at 2.4%, whereas the Retail Price Index is usually higher and is currently 3.3%. So that was another change there for savers, not a positive one, unfortunately. So turning to business investment and business taxation, again, there's not an awful lot of new news there at the moment. Philip Hammond has been speaking about creating a level playing field between the high street retailers and online retailers for quite some time. He feels that really larger companies have been painfully slow to react and to pay their fair share of taxes, particularly the likes of Amazon and Facebook, who've been all over the news recently. So he is introducing from April 2020 what's called a digital services tax Now, this tax is going to be levied on companies who have a global turnover of more than 500 million and is estimated to generate about £400 million per year. Sticking with the high street, there's really been, I suppose, a package of relief to the high street with 1.5 billion boost going to small retail businesses. And when we say small retail businesses, that refers to businesses with a rateable value of less than £51,000. So there's a future high streets fund for councils which they can invest in and transform in town centres. But the headline really, in terms of helping small business, is around £900 million of savings in business rates relief for almost 500,000 small businesses. And business rates are going to be cut by a third over the next 2 years. So that's great news if you run a small business in a town centre. This move, the Chancellor reckons, will see annual savings of up to £8,000 for about 90% of small businesses. So again, good news there. I think one thing to remember though, this is only for those small retailers, and there is still a huge amount of pressure on some of the bigger box chain stores. You know, we were just talking earlier that Kendall's in Manchester is closing, and we do still need the likes of the department stores, the Boots, the Marks and Spencers and so on to attract footfall into our town centres. So there isn't any relief seen for those larger retailers at this stage. So there's also been a great deal of speculation about the rollout of IR35 to the private sector, following on from the introduction in 2017 of the off-payroll working in the public sector. However, any potential change now will be delayed until at least April 2020, and if it does apply then, it will only be to large and medium-sized businesses. So those contractors, one-man band limited companies working in the private sector have a little bit more breathing space than they might have previously expected. In a move that we would assume is aimed to stimulate business investment during the whole Brexit uncertainty period, the annual investment allowance has been increased from the current £200,000 to £1 million for all investments between the 1st of January 2019 and the 31st of December 2020. So if you've got the opportunity to invest and to spend some money within your business, you should take advantage of that extension. There is a new structures and building allowance which comes into effect immediately, and this is meaning that any contracts entered into for construction and non-residential structures and buildings will be eligible for 2% capital allowance. And that applies for any project where the contracts for work began on or after October 29th, 2018. There's also been a capital allowances special rate reduction, and again that comes into play actually from April 2019. So that means that the capital allowance special rate for qualifying plant and machinery assets will be reduced from 8% to 6%. And that's suggested to more closely match average accounts depreciation. Sticking with business really, and looking at tax avoidance and evasion, the Chancellor said that since 2010, measures against tax avoidance and evasion had secured £185 billion of revenue, which would otherwise have been lost. He then very quietly slipped in that HMRC would now become a preferential creditor in company insolvencies. So again, it remains to be seen what impact that might have, but there are whispers that this could be a move which sees the revenue being more willing to push companies into liquidation rather than trying to support them to stay out of liquidation for longer. In terms of investment in the economy, Philip Hammond has always talked about this productivity challenge, and the UK lags behind the rest of the other industrialised leading nations in terms of productivity. So he's announced £1.6 billion worth of new investment in the government's industrial strategy and £150 million worth of fellowships to attract the brightest and best to the UK. He's also said that over the next 5 years, public investment would rise by 30% as the government invests in the UK's roads, railways, research and digital infrastructures. So that's good news if you're operating in those areas. He is really looking to build what he terms as the high wage, high skill economy of the future. Other little bits which were snuck in about saying that Britain is open for business, and specifically saying that e-passport gates would now be open to visitors from the USA, Canada and Australia. And I presume this is, again, to try to encourage travel from those countries in a post-Brexit Britain. Sticking with post-Brexit Britain, there will be an extra £200 million worth of funding for the British Business Bank. So that will replace the European Investment Fund should that be required. And also more money announced for benefits claimants who are hoping to start their own business. So great news there. There had been talk that the Vat threshold might be reduced. He has committed that it will stay at its current level of 85,000 for at least the next 2 years. Now, in light of everything that's going on with making tax digital, I think that most small businesses will be very pleased to learn that this will stay at the existing level and not be further reduced. In terms of other measures, an increase in the national living wage has been announced, so that goes up from £7.83 per hour to £8.21 per hour from April 2019, and that's a 4.9% increase, so it far outstrips inflation. Now remember, national living wage is not the national minimum wage, so national living wage is an informal benchmark. It is not a legally enforceable minimum level of pay. However, he has also said that there will be proportionate increases in minimum wage for younger employees. So again, we will wait to see what the devil in the detail is there. In terms of green and environmental issues, there really wasn't very much to say. There was no coffee cup tax, which a lot of people had thought might happen. Instead, there will be up to £10 million available to help clear up abandoned waste sites, and there will be a consultation on a proposed new tax on the manufacture and import of plastic, which is less than 30% recyclable. So hopefully a start there to reduce the plastic waste that we're all talking about a lot. Large amounts of money have been doled out to Scotland, Wales and Northern Ireland, 950 million, 550 million and 320 million in that order. And there has also been an increase in funding to transforming cities of 2.4 billion. And again, additional money then for other funds such as the Universities Enterprise Fund, the digital capital schemes in the North East, South East and Northern Ireland, and for those of you local to Cheshire, the Medicines Discovery Catapult. There's also money to help self-employed in Manchester and a new economic area in the South Tees. Very little for the UK fishing industry. In terms of duties, fuel duty we already knew was going to be frozen again for the 9th consecutive year, and also frozen were duties on beer, cider and spirits. Tobacco duty, as usual, goes up by the customary 2% above inflation. Universal credit, there has been an awful lot in the news recently. You can't have helped but hear the complaints about delayed payments pushing people into poverty, and many more people on universal credit resorting to food banks in order to feed themselves and their families. So having already committed 3.5 billion to implementation of the Universal Credit Scheme, the Chancellor's announced a further 1 billion over the next 5 years to that scheme. And he has also raised the Universal Credit Work Allowance by £1,000 per year from April 2019. Finally, in the housing market, last year the stamp duty was removed for first-time buyers for purchases up to £300,000. This year he's gone further, abolishing stamp duty for all first-time buyers on shared ownership homes up to £500,000 in value. So in total he said that 121,500 first-time buyers had benefited for this removal of stamp duty. And he also said there'd be an extra £500 million of funding for the Housing Infrastructure Fund, easy for me to say again, which would see a further 650,000 new homes being built. So the only thing maybe left to say is that, said by the Financial Times, there is this Brexit cloud hovering over us. We still don't know what's going to happen there, and there will be a lot more detail to come out of this budget, and really we will see what happens with Brexit and what impact that might have on the spring statement in March 2019, or an upgraded full-blown spring budget in March 2019, should that be the case. But for now, if you do have any questions, please don't hesitate to contact me directly, sarah@inaccountancy.co.uk, and I will also share a link to the full article outlining more details and everything we've discussed now below. Thank you.